Welcome to the new era of investment evaluation. As we approach 2026, the traditional metrics like GAAP net income are becoming increasingly decoupled from the actual cash a business generates. To find true value in a high-growth environment, we must return to the foundational wisdom of Warren Buffett. This presentation explores owner earnings, the bedrock of intrinsic value. For VCs and angel partners, understanding this distinction is the difference between chasing a paper unicorn and backing a cash flow powerhouse. We are looking beyond the surface to see what cash can actually be withdrawn from the business without harming its competitive position. Let us dive into the calculation that defines the smart money's perspective for the next decade. Calculating owner earnings isn't just about reading a balance sheet, it is about surgical adjustments. We start with net income. Then we add back non-cash charges, primarily depreciation and amortization. These are accounting expenses that do not involve an immediate cash secondary. However, the most critical step, and the one most often ignored by aggressive growth firms, is subtracting the average annual amount of capitalized expenditures for plant, property, and equipment that the business requires to maintain its long-term competitive position. This maintenance CapEx is what keeps the business running as it is. By 2026, with AI-driven hardware cycle shortening, this calculation is more vital than ever for accurate forecasting. One of the biggest pitfalls for investors is misclassifying capital expenditure. In our 2026 model, we distinguish between maintenance CapEx, the money needed to stay in place, and growth CapEx, the money spent to expand the kingdom. Growth CapEx should not be subtracted from owner earnings because it is discretionary and builds future value. If a company spends $50 million on new servers just to keep current users happy, that is a cost. If they spend another $50 million to enter a new market, that is an investment. Distinguishing these allows us to see the true underlying profitability that remains available to the owners. This transparency is what leads to superior alpha. While Buffett's original formula focused on CapEx, a modern 2026 interpretation must account for changes in working capital. In a high-growth environment, cash can often get trapped in receivables or inventory. If a business needs to increase its working capital to support sales growth, that is a real cash drain that GAAP income hides. Conversely, a business with negative working capital, where customers pay up front, is a cash machine. We adjust the owner earnings to reflect these shifts. This ensures that the intrinsic value we calculate is based on liquid reality, not just contractual promises that haven't hit the bank account yet. Once we have the owner earnings, we must determine what those future cash flows are worth today. This is the intrinsic value. In 2026, with interest rates stabilizing, the discount rate we choose is paramount. We take the projected owner earnings over the next decade and discount them back to the present using a conservative risk-free rate plus a margin of safety. This gives us a buy price. For VCs, this helps in avoiding overhyped rounds. If the intrinsic value of a startup is significantly lower than its post-money valuation, you are paying for hope, not earnings. We focus on the margin of safety to protect our partners' capital. What makes 2026 different? The integration of AI and automation into the core operations of growth companies has significantly lowered the maintenance CapEx for software-led businesses. We are seeing a shift where the cost to maintain a competitive advantage is dropping, while the potential for growth is expanding. This efficiency frontier means that owner earnings are now a larger percentage of net income than in previous decades. As investors, we look for companies whose owner earnings yield is accelerating faster than their competitors. This is the signature of a 2026 market leader. Our goal is to identify these high-margin outliers before the broader market catches on. Owner earnings are only as good as the moat protecting them. In 2026, we evaluate moats through the lens of data network effects and high switching costs. A company can have high owner earnings today, but if they lack a durable competitive advantage, those earnings will be competed away by next year. We look for high switching costs and cost leadership fueled by proprietary tech. When calculating intrinsic value, we only project earnings that are protected by these barriers. This conservative approach ensures that our investment thesis remains robust even in volatile market conditions. We aren't just buying cash flow, we are buying a fortress. In summary, the path to superior returns in 2026 is paved with disciplined cash flow analysis. By focusing on Buffett's owner earnings, we strip away accounting illusions and see the business for what it truly is, a machine for generating cash. We've looked at the formula, the distinction between maintenance and growth, the importance of working capital, and the necessity of a durable moat. For our partners and co-investors, this methodology provides the clarity needed to commit capital with confidence. True profitability is not a matter of opinion. It is a matter of owner earnings. Let's build the future of value together. Thank you for your time and your commitment to rigorous analysis.